That's my biggest concern right now from an investor perspective is we're back into super duper complacency mode, and that removing tail risk isn't enough. It doesn't justify the multiple expansion. It justifies some multiple expansion, but like I say, a 4 sigma event in less than 3 months just shows you how the stock markets turn into just a little bit too much like a casino for my liking.
Dave Rosenberg, founder and president of Rosenberg Research. It is so great to welcome you back to the show and great to see you as always, Dave. Thank you so much for taking the time to join me today.
100% my pleasure, and thanks for inviting me back on.
Dave, we love having you on, and it's been way too long. The last time we spoke would have been in October of 2024, and so much has happened since then. So let's start where we always start, Dave, and frame things up for the folks who are watching and listening. And that's the big picture, more of that macro view, where we are today, the framework in which you are looking at the world, your outlook, how you're thinking about that big picture as it relates to the economy. And we can throw markets in there. And as you know, Dave, on this show, you can take all the time you need to set the table.
Well, there's probably a whole week's worth of speeches just in all those topics that you just unveiled. I think that, from my perspective, we are just in this ongoing meat grinder roller coaster ride. And a lot of it is just based on this continued elevated policy uncertainty coming out of Washington. With the Trump administration, you just don't know what's going to happen next. So I'd say that, based on what's happened in the past couple of months, and especially since the reprieve on the reciprocal tariffs, and it looks as though that can is going to be kicked down the road even further. It looks to me as though the administration got spooked by the market reaction back in early April, when, as President Trump said, the markets have turned yippee, just really a month after him and Howard Lutnick and Scott Besson said, well, we're carrying out policy for Main Street, not Wall Street. But as it turned out, Wall Street ultimately mattered a lot. Mm-hmm. So we've eliminated a lot of tail risk. It doesn't look like we're going to get a global trade war. It doesn't look like, as fragile as the ceasefire is between Israel and Iran, that we're going to get World War III or get the whole region engulfed in a conflict or any major disruption to oil supplies. And it looks as though, despite all the warts and pimples and scars that the Trump threats of primarying senators and using the bully pulpit so effectively, chances are that this big, beautiful budget bill, which certainly is big, I would argue about how beautiful it is, that it probably ends up getting passed through the Congress, if for any other reason is that nobody wants to be running for re-election in 2026, having the economy fall off the proverbial fiscal cliff. Because, of course, we talk about no taxes on tips and no taxes on overtime and Social Security and EV tax credits and Medicaid and SALT deductions. But what's most important, of course, is that if those 2017 tax cuts on the personal side, if they're allowed to sunset, we will have a major fiscal contraction in the economy next year, and everybody wants to avoid that. That's really the big story. So there was a time when there were question marks around that, but it looks as though we're taking tail risks around a fiscal-induced recession, and we've taken tail risks out of a trade-induced recession, and we've taken tail risks out of an oil price-induced recession from the hostilities over in the Middle East. So that explains how the S&P 500 has managed to rally 24% off those April lows. And so sentiment has taken on a head of steam. So I think that this is all part of the roller coaster ride. But really, when you think about it on the S&P 500, just barely above where we were back in mid-November. So we've done a round trip, maybe a round trip and a little bit more. It seems, though, that one of the scares coming out of DeepSeek and all the nervousness about what these big tech companies were going to say in their earnings announcements, it looks as though the AI spending craze is continuing unabated. So, of course, it's been the Mag 7 up more than 30% from the lows. I mean, NVIDIA is up almost 70% from the lows. They've led the charge again. But the market has broadened out. There's no question about that. But a lot of this has been sentiment driven. And I say that because what's moved the most have not been earnings expectations. What's moved the most has been the market multiple. And, I found it very interesting that the forward PE multiple in those dark days in April, when the stock market was down almost 19%, the trough multiple was 18. And, Julia, when I started in the business in the mid 80s, I mean, an 18 multiple was egregious. And today it's a trough. And we bounced more than 4 points off that. In less than 3 months, we've gone from 18 multiple to over 22. And that's astounding. And in fact, when you look historically all the way back to 1990, so you're talking about 35 years of data collection, this has only happened 0.4% of the time in the past that you've had such a massive bounce back expansion in the market multiple, which is the heartbeat of investor sentiment. That's all the multiple is. The multiple isn't a real dollar, that's earnings. And earnings estimates haven't really moving. And they're well below where they were from their previous peaks. What's moved is the market multiple because investors are building confidence that they had lost. They've rebuilt that confidence rather dramatically, but it's a 4 standard deviation event, the sort of market multiple move that we've seen. And maybe, one other thing that's been taken off the table, another war, is an escalating China-U.S. trade war. That's another war. That's not really a war, but another aspect of the trade war that's been taken off the table with this rapprochement, at least as it pertains to, easing the restrictions from China on rare earths, and then the U.S. restricting some of the aggressive tariffs that Trump had put on China several months ago. So I think that we have to differentiate really between, what is ultimately good news, and there's not a lot of good news. It's just that we've taken out a lot of bad news. But you see, in the stock market, that can deliver a tremendous recovery because in the stock market, reduced bad news is no different than absolute good news. In real life, there's a big difference. Big difference in you get into a car accident, and thankfully it wasn't like a major one with fatalities and just a fender bender, but a fender bender is still going to cost you a couple of $1,000 at the local garage. In the stock market, so long as you avoided the fatal accident, it doesn't matter if you got a fender bender is still going to trigger a profound increase in investor sentiment, which is what we've seen. And so, to complete the analogy, what has not gone away, in my opinion, are the risks of a recession. Although policy uncertainty has come down, it's still about double what a normal level is. And that's going to be enough to keep consumers and businesses very cautious, and they're the ones that make up the economy. The housing market is in a huge state of disarray. The data have been absolutely horrible, whether you're looking at new home sales or housing starts, building permits. Now home prices are starting to crack across a broad array of indicators. That's something brand spanking new. As the stock market is hitting new highs, house prices have actually started to deflate. And for the household sector, that's sitting on all this housing wealth that they've been spending money on, that is something we can put aside for now in terms of that being more of a headwind than a tailwind. All the while, and this is something that I agree with Donald Trump on, although I wouldn't be vocalizing it, is that Jay Powell and the Fed are being excessively tight in their policy. I can understand why, because they're still so concerned about the tariff effect on inflation. But, the Fed is pinning the funds rate 125 basis points above its own equilibrium or natural rate of interest estimate. Monetary policy is still very tight. And I think that the tariffs and the Trump interventions verbally are a headache for the Fed. I keep on saying that every time that Donald Trump insults Jay Powell is self-defeating, because the one thing that the Fed will always guard with its life is its independence and its credibility. But the yield curve is very flat. Interest rates are still well above their equilibrium level. And you are seeing that in the most interest-sensitive or credit-sensitive sectors of the market, of the economy, being autos and housing, which traditionally have been leading indicators, especially the housing market. And there is a big dichotomy, I think, between what the stock market is doing right now and what the economy is doing right now. And I say that because everybody, including the folks at the Fed, were saying we're going to wait for the weakness in the soft data to morph into the hard data. But that's already happened. And when I talk about the soft data, we're talking about anecdotal evidence of what the economy is doing, not hard data that come out of the Commerce Department or the BLS, but mostly survey data, consumer sentiment and confidence indices, business, manufacturing services indices. We actually roll these sentiment numbers, these soft data as they're called, into a GDP model to try and figure out what is the survey data consistent with as far as what it means for the hard data. And it's actually consistent with an economy that is contracting at a 1% annual rate. Now, we all know that the economy is not contracting at a 1% annual rate if you focus on the GDP data. But let me just say this much. A year ago at this time, because we have monthly GDP data, they go to April. Now, we also know, looking at the broad array of May data, that there was no recovery at all. There was no spring in May when it comes to GDP. We don't have the official data yet from S&P Global, but we have the April data. Well, guess what? This time last year, real GDP growth on a 12-month run rate was 3.2%. Today, it's running at 1.3%. Now, back when I started in the business in the mid-'80s, we got down to the low ones in real GDP. And clients would ask me, this is back in the day when I started at the Bank of Nova Scotia, clients would say, we're 1.3 on real GDP. When's the recession starting? Today's investor says, oh, it's 1.3, but it's still got a plus sign, right? So that sort of shows you again how sentiment is driving this market, so long as it's got a plus sign. But here's the warning, is that real GDP, because the quarterly averages that we see, and of course we had a negative 0.5 on the first quarter, when you look at the sequential pattern of the monthly data, this is what most people don't know. Of course, I know because I'm an economist and I look at the data granularly, that real GDP has actually been negative sequentially 2 of the past 3 months and in 3 of the past 5. And when you look at real GDP on a 3 and 6 month basis at an annual rate, it's actually fractionally negative. So it could well be that the recession that nobody sees, certainly the stock market doesn't see it, that this recession may already be unfolding before our eyes. And the last time we spoke, which was before last year's election, there was no signs of recession at that point. But those signs of recession are back. What makes it different this time around than, say, 2022, 2023, and I know people will say, well, you're calling for recession back then. I don't cry over spilt milk. I learn from my mistakes and I drive on. There is a variety of reasons, massive antidotes, especially from fiscal policy, excess pandemic savings, the fact that almost every homeowner had locked in and were not vulnerable to the interest rate shock put forward by the Fed. That's all changed. What matters is making the call right now I find it astounding that practically every Wall Street economist, even those that were calling for a recession mistakenly in 2022, 2023, are extremely shy to call for one right now because they got it wrong. I don't think that does much service for their clients or their investors. Admit your mistake, talk about where you got it wrong, why you won't get it wrong again, and then drive on. Because what happened in 2022, 2023, you certainly cannot extrapolate that experience into what's going to happen over the course of the next 12 months. So from my lens, what's interesting is that in 2022, when we had a steep correction in the stock market was nervous about a recession, nervous about a Fed-induced recession. Recession didn't come. And everybody in 2022 was talking about a recession. And frankly, Julia, if the people that weren't calling for a recession were still nervous about one, nobody is nervous about a recession right now. I would say that the odds are higher today than they were in 2022. And the irony of ironies is that nobody is talking about a recession. Nobody believes it's going to happen again. There's no asset class that's even priced above 1% for a risk of recession in the next year. It has basically been thrown into the waste paper basket. And in fact, one of my competitors was on CNBC last Friday, who shall remain unmentioned, who actually said that the US economy has become, in quotes, recession proof. And oh boy, that takes me back to my days at Merrill in the summer of 2007, when Robert Tall at Tall Brothers was also on CNBC and said that the housing sector was no longer cyclical. I was at an airport with Richard Bernstein, and we were just having a beer at the bar with CNBC on the TV when he said that, and we both almost fell off our chair. Around the same time, by the way, that Chuck Prince was telling everybody to keep dancing till the music stops. So I would just say that that's my biggest concern right now from an investor perspective is we're back into super duper complacency mode. And that removing tail risk isn't enough. It doesn't justify the multiple expansion. It justifies some multiple expansion. But like I say, a 4 sigma event in less than 3 months just shows you how the stock market's turned into just a little bit too much like a casino for my liking.
Dave, that was an incredible frame up to this conversation, and I took a ton of notes, a lot of threads I would love to pull on with you. And as you point out, there's a lot of complacency out there, and pretty much no one is expecting a recession. I was just looking on the prediction markets, Kalshi. It's only forecasting a 25% probability of a recession. When I'm listening to you, you're saying the probability is higher than 2022 when a lot of folks, as you rightly point out, were expecting one. What is that probability for you today if you had to put a number to it?
Well, I have difficulty with probabilities like that. And I'll tell you why. It's like, what are the probabilities that a woman is pregnant? I'm 60% pregnant. I'm 40% pregnant. I mean, it's 0 or 100.
Right. Yeah.
0 or 100.
Yeah, you can't be a little bit.
These economists, right?
Yeah.
Look, I spent most of my life on Wall Street and Bay Street, and you have to have something to say. So when you say, oh, well, my recession call is 60% recession. So if you get the recession, you go to your clients and say, well, I told you it's more than 50-50. If you don't get the recession, you say, well, I was saying 40% chance of no recession. They are meaningless statistics. All these people, that it was just around the trading tower file that even the most, even the people that are most shy about ever calling for a recession were saying, I'm going from 0 to 20, or I'm going from 20 to 40. And I just roll my eyes and I'm thinking, like, how does that help anybody? How do they never even explain how they come up with those probabilities. You're either in a recession or you're not. You're either in an expansion or you're not. You're either in a bear market or you're not, or you're either in a bull market. They're binary. And so I would say that I'll reiterate what I said earlier. I think the recession is already starting. I'm not going to attach a probability on it. I think that human nature is such that once burned, twice shy. So people who called for recession and got pasted, and I'm guilty as charged, 2022, 2023. I didn't anticipate all the antidotes, as I said before. I didn't expect that every penny of the $2 trillion of excess pandemic spending was going to be put into the economy. None of it was saved. My assumption was wrong. Going into the pandemic, 40% of the household sector didn't have enough savings, didn't have enough coins in the piggy bank or cash on hand to get through 3 months of vital economic activity. I thought, well, that memory is going to be well entrenched, and that a lot of the stimulus on the checks were going to be saved. Because we'll probably see another health crisis in our lifetime. Well, it all got spent. You know, the thing about economics, it's a study of behavior. It's a social science, but it's a study. I mean, we're all borderline psychologists. I didn't think all that money was going to get spent. It all got spent. I didn't anticipate we're going to have 5 years in a row of 6% plus deficit GDP ratios. And there was tremendous, the Inflation Reduction Act, talk about an oxymoron, the CHIPS Act, all that spending. And so basically, you know, the bear market, in my opinion, wasn't rational thought. Like, I'll ask you the question. Did you think we'd be sitting here today and that the level of government spending in the United States would be 53% higher than it was just before the pandemic hit? So we had the pandemic spending. Yeah. We had the pandemic spending, then more spending, and then more spending. And you just go on a treadmill.
Yes.
And so I didn't anticipate that the fiscal stimulus, they were going to pile on. I mean, with all due respect, and I mean that respectfully, FDR in the Great Depression never ran deficits for this long, this large in the 1930s. We're behaving as though we're in a Great Depression. That's how they're running. We're fighting. So this is
what happens when we do enter something where it is an emergency then?
There's not going to be enough. There won't be enough fiscal flexibility to fight a future recession. There will not be enough future flexibility without really blowing things up. We have never gone into recession with deficit GDP ratios between 5 and 7%. And you know that in a recession, just when the automatic stabilizers kick in, like unemployment insurance and welfare and so on and so forth, the deficit to GDP ratio in a recession naturally, without any stimulus, expands 2 percentage points of GDP. So you layer that on to what the starting point is, and then you're going to have Congress and the president doing what? Cash for clunkers and more spending. Where's it going to come from? We're already stuffing the gills at these treasury auctions. Where's the money going to come from? Unless the Fed re-expands its balance sheet. So, yeah, I say that the flexibility in the future for our beloved fiscal policymakers is going to be seriously constrained. But the point I want to make is that people think that this big, beautiful budget bill is stimulative. No, it's not. All that deficit increase that all the hawks are talking about, and maybe justifiably so, because I said before, once the government puts in spending machinery, it's deemed to be temporary at the time, like the pandemic. It's not temporary. And then when you cut taxes, remember the tax cuts were supposed to sunset, but they're not being allowed to sunset. So when you're talking about all those future deficits in the next decade of around $4 trillion, it's all just coming out of, that's not tax cuts for tips, okay? That's not spending on the border. That's all extending the status quo. Extending the status quo and ensuring that those 2017 income tax cuts don't sunset, that's your story on fiscal policy. That's what I'm talking about. But you see, people are lulled into this big, beautiful bill. People are lulled into this view that we have some big fiscal stimulus coming. No, those future deficits are basically extending the status quo. And on top of that, a good chunk of those deficits are interest payments incrementally higher on the higher stock of outstanding federal debt. There is no stimulus coming out of the federal government when you add everything up together. And then we have the Fed deliberately keeping monetary policy tight because they're the proverbial deer in the headlights and they don't know how the tariff file is going to play out. So they're keeping policy very tight. Who's that hurting the most? It's hurting the housing market the most with mortgage rates where they are. Home prices have come down, but are still in nosebleed levels. I think the Case-Shiller home price index is it's like 150% higher today than it was coming out of the financial crisis. But now there's helium coming out of that balloon. But we have an affordability crisis in the housing market. And what happened that's interesting was when the Fed cut rates to zero in 2020 and then inadvertently told everybody they're going to stay there to perpetuity, everybody just locked in. Everybody locked in. I think you had the grand total of 4% of existing mortgage borrowers who are not locked in. So the Fed raises rates 500 basis points, nobody gets hurt. But you see, everybody was prisoners in their home because if you're going to move, you'd have to refinance and get payment shocked at the same time. So we had this massively sclerotic housing market where there was no demand because of affordability, but there was also no supply because nobody was willing to put a for sale sign on their lawn. So even if you had a modicum of housing demand, it caused home prices to skyrocket. We came through the past couple of years with really quite a surprising bull market in home prices where demand was actually very weak, but that's because there was no supply. But look what's happening right now. Right now, all those people that benefited from being locked into low rates, they're not locked in anymore. You're up to 20% of the market now. People are refinancing and they're facing the payment shock. And you're seeing, albeit from a very low level, delinquency rates in the residential mortgage sector. Now, they're not as bad as credit cards and auto loans, which are at 14-year highs. But in the mortgage market, they're starting to rise. And guess what's happening? You're seeing a major thaw in the supply. In fact, if you look on a year-over-year basis, there's now a 25 percentage point gap between the growth of supply of homes in the resale market over the growth of demand.
I believe it, Dave.
So the month supply, and this is going to, so the supply demand backdrop, this will be great news for wannabe buyers and renters who were squeezed out the past few years, but it's going to lead to a negative wealth effect on spending because most people actually own their home. Most people do not rent. So this is going to be a negative wealth effect for the majority of the population, and nobody talks about it, but it's actually just now starting. But that was one of the distortions that was created. That's one of the reasons why the locked in cycle, which prevented homeowners from facing the interest rate shock. That was one reason why we averted a recession. All that gobs of fiscal stimulus. Because you got to think, how could we have had a Volcker-esque tightening in policy in 2022, 2023? And we didn't upset the apple cart at all. But you see, what happened is that you had, the most cyclical stocks in 2022 were down almost 30%. That was a massive drawdown. And people are saying today, I'm not going to make that mistake again. So the fear of any recession, maybe that's what we should fear the most, is the lack of fear, is actually quite gripping.
Gold prices have been breaking all-time highs this year, but price appreciation isn't the only way to profit from owning gold. You can earn a yield on gold paid in gold without selling your gold or silver. Unlike dollar yields that can be slashed or even go negative, a yield on gold paid in gold means more ounces in your account every month, not paper. Monetary Metals is revolutionizing the way people invest in gold and silver. Instead of paying to own the metal, now you can get paid to own it. Right now, there are opportunities for you to earn 4% on gold paid in gold in their marketplace. The interest you earn is paid in ounces of physical gold or silver, which you get in addition to any price appreciation that comes from gold and silver during the year. The question is this: why earn in dollars when you can earn in gold? Join thousands of investors who are earning a yield in physical gold and silver every month with Monetary Metals. Visit monetary-metals.com/Julia to learn more. The psychology part that you're getting at too is so interesting too. And like when I think of housing, I'm one of the ones who wants to buy, and I like to run or walk every morning, and I'm noticing more supply that's not moving as fast as it had been, call it 2 years ago. And I'm trying to be patient too here because I do see prices coming down, but I imagine there's a lot of like psychology. Like if you point out, so much of our wealth is in our home. So I imagine there's probably like that kind of emotional, psychological bit to it as well. But then on the other side, you point out this dichotomy between the stock market and the economy. I read comments from my viewers, and there'll be folks who say, I'm in a recession. I feel a recession. So they'll hear folks like yourself, and they will 100% agree with you. But I also imagine too, like as you point out, we saw in the stock market with the investors that 4 standard deviation event, and that kind of says a lot about their confidence in psychology. Do we have like just a bifurcated economy? Like, I don't know if that's a good question, but I hear from people who are saying, I'm feeling it, I'm in a recession, and others who will say, absolutely not.
Well, I guess I should probably caveat some of what I said because we're so fixated on the S&P 500. And when I started in the business, people said to me, don't focus on the NASDAQ, don't focus on the Dow. The market is the S&P 500. However, they're all large caps, and now it's become mostly a growth index. It's a growth index. If you look at the ratio of the market cap of growth over the market cap of value, and value is mostly cyclicals, it's at a 23-year low. That ratio, the relative strength index, is at a 23-year low. So the S&P 500 is all the mega cap companies, and it's become a growth index. And the thing about growth indices, growth stocks, is they have a very long duration. They have a much longer duration than value stocks or cyclical stocks. So it could be, like I'm trying to find a rational explanation, as opposed to throwing my hands up in the air and saying, oh, this just doesn't make any sense. It could well be that my competitor who said the economy is not recession-proof, or the economy is recession-proof, which I don't believe. I don't believe the business cycle is dead. I don't believe that Mother Nature has had a coronary and is no longer to be seen. But it is, you could argue, a different S&P 500. There could well be a case to be made, because it seems to me as though you have these mega caps that are being fueled by the AI craze, and the spending on AI does seem to be something that's transcending the business cycle, and that's really what's dominating the index. Take a look at the more cyclical parts of the market, the home builders, for example, the transports, telling you a slightly different story. So we have to drill deep into the components of the stock market. On top of that, look what the small caps are doing. Small caps and mid caps are still both in major correction mode. They've come off the lows, but nothing like what's happened with the mega caps. And the mega caps really have morphed into more growth indices. So there's that aspect to it as well. I think it would be foolish to say that the S&P 500, even if it's less cyclical than it used to be, won't go back into a major correction or bear market if we get the recession. I think it will, but you can draw the case that It'll be a lot worse in the more cyclical value part of the market, notwithstanding how cheap it is. It'll get cheaper, and the small caps. So you can make that argument. But when we get into the recession, there will be a general risk-off trade. A mild bear market, okay? A mild bear market, like, for example, in 1990-91, that was a mild bear market. Fairly significant recession, mild bear market, but the market was still down 20%. And I think that even if you're a long-term investor, you'd rather not participate in a 20% drawdown on the stock market. That's just a mild. Most recessions would see the S&P 500 go down 30 to 40%. And you could say, well, because of the growth bias and because a lot of the support from AI and all the derivatives is truly secular growth and might hit a bump but won't reverse in a recession, you could buy that argument, but the market will still go down. You'll still lose money in the stock market. I make this argument and people roll their eyes only because nobody believes that there's going to be a recession. In recessions, you get a contraction of the multiple because people get nervous. And the multiple, like I said, is just the heartbeat of confidence in earnings. And then you have earnings go down in a recession. And they often go down quite a bit. That's what makes recessions not so friendly for the stock market. It just so happens that earnings are part of the economy. And in a recession, the economy experiences a haircut. We talked before about, the odds. Okay, I'll be charitable. Let's go back to the May FOMC meeting. Now, at the minutes of the meeting, now we'll get another one from the meeting we had a couple of weeks ago. But at the May meeting, it wasn't that long ago, all the FOMC minutes always start off with the Fed economic staff overview of the economy and their forecast. Every set of FOMC minutes. That's where you start before the policymakers get into their deliberations. Okay. Mm-hmm. What did the Fed staff tell us at the May meeting? Now, at the May meeting, we already basically, the worst part of the trade wars were over. A lot of the tail risks were coming out of the system. The Fed staff said that they were reducing their GDP forecast for this year and next year. And they said that the odds of a recession were now equal to their GDP baseline forecast. Whoa. I'm shaking my head. What did they just say? They just said that recession risk is the same as seeing their newly minted lower GDP forecast coming to fruition. So they just told you mentioned before 25% from the predicted market. The Fed staff said, well, 50% pregnant.
That's okay? It's a clever way of saying 50%. Huh.
Well, that's exactly right. That they said 50%. Yeah. But then I say, okay, look, I'm not going to say the Fed staff. It's gospel. But I think maybe we should pay attention to it, especially when at a 23 multiple, almost 0% chance of recession. You look at credit spreads, high yield investment grade, no recession. But the Fed staff just said, okay, well, our models are telling us we're in a knife's edge. It's a coin toss. Nothing's priced for that. Okay, maybe they'll be wrong. Obviously, there's a good chance they'll be wrong, and the markets are saying the Fed staff forecast is irrelevant. But then you go to the Beige Book, the Beige Book is the gold standard for all the anecdotal evidence I said before. What is a bigger survey than the Fed Beige Book? And people always ask me, well, why is it beige? Well, because that's the color of the cover. The Fed's been doing the Beige Book since 1970. It comes out every 6 weeks. It is the most comprehensive assessment. Qualitative, mind you, there's no numbers. Most broad-based and relevant qualitative assessment of the U.S. economy comes out every 6 weeks, and it covers every region, and it covers every single sector. And what did they say? And this just came out a couple of weeks ago. The Beige Book said in its opening sentence that economic activity is declining slightly. And people will say once again to me, the same people that say, well, but the plus 1.3 year-over-year GDP, it's not negative, it's plus. Sure, knock yourself out with that one. Now they'll say, well, they said declining slightly. It's very rare that the Beige Book will ever mention that the economy is contracting slightly, modestly, moderately. The fact of the matter is that the economy is in contraction mode and consistent with the monthly GDP data, which somehow nobody seems to either care about or even believe, which I'll get into in a second. But the Beige Book stated that 3/4 of the economy are either contracting or stagnating as we sit. 3/4. Now, we ran some data science. Off the Beige Book. And you got to go back to 1980 to find the last time, the onset of that recession, where the tone was as downbeat as the one we just saw. Do you know that this Beige Book was more downbeat on the economy than the one they published at the end of 2007, when the recession, I should call it the Great Recession, the recession that nobody saw happening.
Except you saw it, Dave. You saw it.
Well, I could say that I saw it, but there was also a false signal in 2022 and 2023 that you can say that I fell for. So nobody's perfect. But I appreciate the plug. But I say, look, I would not browbeat Jay Powell publicly. However, if I was in the media and I was there at the press scrum after the FOMC meeting, I'd put up my hand and I'd say, oh, Mr. Chairman, I got a question for you. Why do you spend so much money and expend so many resources on the Beige Book when you don't even listen to it? And why do you have all this Fed PhD staffers on hand when you don't even listen to them? Because all Jay Powell talks about is how the economy is solid. You see, to quote Shakespeare, here's the rub. Jay Powell continues to characterize the economy as being solid. Mm-hmm. I just finished telling everybody the year-over-year run rate is 1.3, and the 3 and 6 month trends in real GDP is negative. I cited the Beige Book, the venerable Beige Book that's only been around for like 6 decades, the Fed staff forecast. And with that, when you look at the tone of the FOMC press statement and the tone of the press conference, Jay Powell is talking about the economy as if we were back 12 months ago. But then again, I'm thinking, well, what else could he really do if he's not going to cut rates? And we're talking about not even easing policy, but taking out the restrictiveness. He's got to have a cover. How could you say I'm not cutting rates, but the economy sucks? And I got news for you. You take a look at the gamut of data in May, it looks like GDP contracted again. Look at what housing starts did. Look at what new home sales did. Look at what retail sales did, real consumer spending. Look at the broad array. Industrial production was down 0.2. And he's calling the economy solid. And here's the thing is that people actually believe him. Okay, this is the power of the Fed. So people say, well, he's not cutting rates because he's calling the economy solid. Well, if you believe the economy is solid, now notwithstanding the valuations, they're not a very effective timing tool to begin with, but if you believe the economy is solid, if you believe that the economy has become recession-proof, if you believe that the equity risk premium at 0 is appropriate, which is the stock market's way of saying that the S&P 500 has become a riskless asset class. It's as risky as a treasury bill. If you believe all that, then this market is for you. Buy it. Then that's not my view. But that is basically what the market message is. And it's being fueled by this constant refrain from Jay Powell that the economy is solid. Well, I don't believe that, but I'm not running hundreds of billions of dollars of money. But I got news for you. Because a lot of these people that run hundreds of billions of dollars of money are clients of mine, and they believe Jay Powell. So that helps explain. It's what I said before. It's about expectations, about emotions. The stock market is a psychological barometer. Okay, if it was just about earnings, the stock market would be doing nothing. If anything, it'd be down, not at a new high, because earnings estimates only recently have bottomed out, but only after being down significantly over the past 6 months. The multiple, like I said before, is the pulse of confidence. And when you get the Fed chairman talking about that the economy is solid, a lot of people are going to believe him. Okay? Like, for example, when Ben Bernanke came out and said, there's no subprime will stay contained, and home prices never decline nationwide, he said that in 2006. Okay? He didn't say that in 2008.
Mm-hmm.
He said in 2006, and I remember being at Mother Merrill, and everybody was saying to me, well, Rosenberg, you have your view, and Bernanke has his view, and I'm buying Bernanke's view because he's Fed chairman, and the stock market didn't peak until October of 2007. And then, as they say in Quebec, les jeux sont faits. The gig was up. So I guess you got to place your bets with or against the Fed. My bet is actually with the Fed staff, okay? My bet is not with the Fed chairman.
Dave, let me ask you this. I take it you're of the camp that he should be cutting. And I wonder, the longer he waits, does that create a credibility problem? If you wait too long, what could happen there? Because we know they missed the whole inflation's transitory. They messed that one up. So I wonder, is there a credibility issue? And is the reason he's not cutting it, is it because Trump comes out and calls him stupid or dumb and that he should be cutting? And I know if he cut, maybe some people think, oh, you're political. But I also wonder, if you're not cutting, is that also making you look like you're political?
Well, I have a problem with the political because he was appointed by Trump back in 2018. So it's not political. It's basically part of what you said, that the Fed still has this miserable memory of blowing it on transitory. Now, when push comes to shove, okay, you had a lot of people out there saying we're going back to the 1970s on stagflation, and that never happened. Those people are ever put to task on their call. We're back to the 1970s. We had 18 months of runaway inflation. 18 months, not 18 years, not 10 years. But then again, who thought we're going to go from 0 to 9 in an 18-month span? But the Fed corrected that. And of course, not just the Fed, but the economy reopened. And we weren't facing recurring supply shocks, every 6 weeks. So the Fed still has this remorse and collective guilt, and they believe that their credibility was damaged, and that is still on their minds today. So I would agree with you on that. The other aspect of it, as you said, is that it's self-defeating for Trump to continue to badger and insult Powell publicly, because it raises the bar for the Fed to do anything, because they will always protect, as an institution, they will always protect their integrity and credibility and independence more than anything else. I'm not so sure the president quite understands how the Fed thinks as an institution. All he cares about are lower interest rates. I think that so that part is really self-defeating. The tariff file, the Fed is divided right now as to, is it going to be a one-off price shock, a level price adjustment, or will it be a series of price adjustments? Because when you think about the way trade policy is being implemented, it's really piecemeal. It's not like, okay, we're going to get this over with right now. There'll be a one-time level price shift and we'll move on. And so I'm sensitive to that. I'm sensitive to the fact that the piecemeal way that the trade policy is being implemented means that this is going to be a slow bleed. This is not going to be over with quickly. I respect that. But I think that what is happening is we are seeing cracks emerge in the labor market. We are seeing cracks emerge in the labor market. And people just look at non-farm payrolls as if 139,000 headline that we got for May is a very good number. But hey, it was above consensus, great number. Then we had all the downward revisions, and the numbers are being revised down like 3/4 of the time. And we know from the household survey, and we also know from the JOLT survey, that there are cracks emerging. And maybe you don't see it in the initial jobless claims numbers, but they're certainly evident in the rising backlog of continuing claims. And you're seeing that the ranks of the unemployed, they're finding it tougher and tougher to find a job. And that's because the hiring rate has come down so much. And that is going to lead to a higher unemployment rate. And that is going to take nominal wage growth down with a lag. And this is where I differ. We had a situation in that, say, 2021, 2022 period where we had the inflation, but it fed into wages. We had a wage price spiral, not like the 1970s, but we had an 18-month wage price spiral. And what caused it to become self-reinforcing was that the price increases fed into wages. Totally different labor market back then.
Yep.
The hiring rate was surging. The voluntary quit rate, what I call the take this job and shove it index. People were job hopping like it was nobody's business. And so the job opening rate was surging. None of that is happening now. The labor market was tightening dramatically, and now the labor market at the margin is actually loosening up. So I don't expect that we're going to be getting the tariff increases insofar as the retail sector can pass it on. I think there will be tremendous consumer resistance to it. And what's going to happen more than likely is that the tariffs are going to lead to a contraction in real wages, which then leads to a contraction in real consumer spending and then compounds the recessionary pressures. This is not, again, what people are talking about. So I think that what makes this price shock different than the one coming during and the COVID experience is that this is going to be happening in a period where the labor market is loosening up, not tightening it up. So it's going to hit the wall in the labor market. And this is what I find astounding is that, here we have Jay Powell's been telling us for months that he sees no evidence of inflation coming out of the labor market. To which if I had a second question to ask, Mr. Chairman, at the press scrum, if you don't see inflation coming out of the labor market, how do you see inflation in the system at all? It doesn't make any sense. If you're telling us that there's no inflation coming out of the labor market, then ipso facto, any tariff-induced price increases will hit the wall in the labor market, and what you end up with is not inflation, but you end up with wage compression and consumer demand contraction. So once again, none of this adds up. Jay Powell does not want to cut interest rates. Not now, not in July, maybe in September. But there's another element to it. You talked about political. I'm not going to say this is so much political, but it's more legacy, more Jay Powell's legacy. His term expires in May. And he probably feels, using the words once burnt, twice shy, which I said before about making recession call, he's not going to double down on getting inflation wrong. Okay. Despite what I just said about the labor market, my own inflation view, he obviously has residual concern over another round of inflation from the trade file. I'm convinced that if it weren't for the tariffs, he probably would be cutting rates right now. But time is running out. And he was thoroughly embarrassed for a couple of years. Now, the Fed corrected that, but now he's left with another policy dilemma and a tough policy choice. What side is he going to come out on? He's only got till May. He doesn't have time to correct an inflation mistake if he makes one. He had time after the COVID inflation mistake. He doesn't have time this time. And he wants to be remembered with a certain degree of legacy and dignity and respect. the last thing you want to be as a central banker is compared to Arthur Burns in the 1970s, although that's an unfair comparison, by the way. Arthur Burns was a brilliant economist, but he gets blamed. He's like Billy Buckner, on the Red Sox. He gets blamed. Arthur Burns gets blamed. You bring up Arthur Burns, and it's not a positive word association for people in the financial markets. Oh. But you bring up the name Paul Volcker.
Yep.
I mean, there's monuments and statues. Well, because Paul Volcker killed inflation, but he killed inflation not through some magic wand. He killed the economy, not once, but twice. And he killed inflation. You want to be remembered as central banker as Arthur Burns or Paul Volcker? And nobody remembers that Paul Volcker killed the economy. Nobody remembers that Don Reagan, who was Ronald Reagan's Treasury Secretary, wanted to get him fired in the early 80s. He didn't get fired. Paul Volcker was not too popular in the early 1980s, okay? But it's like there's monuments made to this. Hey, he's a legend. And if I was Jay Powell, maybe I wouldn't mind being a legend too when all's said and done. He won't be a legend if he leaves a legacy of inflation behind. Besides the fact that, look, Donald Trump is already going to announce, it looks like September, October, his new Fed chairman. Normally, the president sort of makes the announcement 3 months. Now it's going to be at least, what, 6, 7 months?
Yeah, 6,
Maybe
7, 8. Yeah, something like that. Yeah.
Yeah.
Who do you think? Who do you think it's going to be?
I don't know. I shudder. The only person that I mean, Kevin Warsh is the only one that I would take seriously. But I don't know why Donald Trump would want to appoint Warsh because he's not a yes man.
He's got a 27% probability on the prediction markets. Waller.
Warsh? So
on Kalshi, it's Waller at 29%, Warsh at 27%, Hassett at 16%, Scott Besson at 12%, Judy Shelton at 9%.
Well, Shelton, you see, the Shelton is like a borderline libertarian. I mean, there's some people on there that are not going to deviate from the Fed stance. Then there's some people on there who are clearly yes men and political. You're talking about political. So I don't know who it's going to be. You just gave those odds, from whatever 12% to 28% amongst like 5 or 6 people. That's a pretty tight range.
No one really knows. Yeah.
No one really knows, and it could be somebody who's not on that list.
Exactly.
That's just speculation, but you got to be thinking that Donald Trump is going to want to have somebody who wants to cut interest rates aggressively. And there's a couple on that list who I think would fit that bill. The Fed, you talk to me about whether or not, it's funny, you asked me whether Jay Powell is political. Jay Powell is doing everything he can to be non-political. The person who is making the Fed political is the president. He's making the Fed political. And so it'll be interesting to see who he chooses and how the market's going to respond.
Mm-hmm.
I don't really know.
Yeah.
I don't really know. It's interesting that in Trump 1.0, the world was a stable place and his cabinet was a revolving door. Because he was inexperienced and didn't have, quotes, the right people around him. Today, the world has gone mad by several standard deviations from the past. But his cabinet is remarkably stable. So we just basically done a complete 180 here.
Yeah.
So he's going to choose somebody, I believe. If he picked Kevin Warsh or Shelton, I'd be really surprised that he'd want to pick monetarists.
Mm-hmm.
I think he wants to pick the most acute dove out of the lot and somebody that he can push around. He can't push Powell around. He's got to get somebody he can push around so that it'll really be Trump calling interest rates from the sidelines without any pushback. Now, I don't know what that does to the FOMC because whoever the Fed chairperson is, and Jay Powell himself, they only have one vote.
Yeah.
They only have one vote. Can you imagine a situation where there's a new chairperson appointed that the FOMC has no confidence in, and they start resigning. So these are the things that we should actually be contemplating.
Yeah.
These are, you got to be wondering, like, what's going on here? Why, your opening comments are talking about the stock market, the ripping stock market, the multiple expansion-driven stock market. But we never talked about maybe what is the most important price in the world, which is the US dollar. Stock market up 24%, US dollar down 11%. By the way, on a Sharpe ratio basis, an 11% decline in the dollar is equivalent to a 24% decline in the stock market. The US dollar is in a bear market. It's not just a correction.
But Dave, is that the asset price then that is pricing in a recession then, like the dollar then? Because you said no assets are pricing.
It's pricing in something.
Yeah.
It's pricing
in. And what about gold?
Yeah,
gold too.
Gold. Yeah, gold. I mean, you could argue Bitcoin. Yeah, so there's all this market segmentation. The stock market's telling you things are just lining up roses. Although just the mega caps, right?
Right.
I'm not saying the market hasn't broadened out, but I mean, the little guys, the small caps have lagged way behind, and they're still in a major correction mode. If there's all this inflation, reflation, why isn't the bond market blowing up? Like, why is the 10-year treasury don't yield down 35 basis points from where it was in the middle of May? What's that all about? We're supposed to have reflationary growth in the stock market. Well, you see, you could say, well, the stock market has taken tail risk out. And at one point, maybe a month ago, I agreed with that. But now we've gone to new highs. So it's done more than just take tail risk out. It's now pricing in something rather benevolent. But the bond market's not selling off. It's range trading. The dollar goes down every single day. And maybe that's, when I said before, I erred when I said that there's no asset class pricing in a recession. Maybe that's what the dollar is doing.
Yeah.
Or maybe the dollar is telling you something about its view on fiscal policy. How could the dollar be going down? How? Usually the country imposing the tariffs sees the adjustment of its currency going up, not down. Most other central banks in the world have been cutting interest rates, but not the Fed.
But also, maybe Dave,
how's the dollar not going up?
Yeah. So
the dollar going down is maybe the greatest, shall we say, non-confirmation for this risk-on move that you've seen in the equity and the credit markets over the course of the past couple of months. That's the fly in the ointment.
Interesting. It also makes me just wonder, though, like the appetite for gold, too. Maybe you've pointed out that gold's been behaving much more like a currency these days.
A currency that is no government's liability. And so 100%. It's been a safety valve. It's also got tremendous fund flows from the fact that most of the world's central banks are diversifying into gold in their foreign exchange reserves. But gold, as you said, this is a real mystery, right? Because how do you value gold anyways? There's no dividend discount model. You're not looking at default rates and recovery rates like you do in the credit market. How do you value gold? Gold is basically 1 divided by C, where C is certainty.
Yeah.
And we're still in a bit of a policy bog. Notwithstanding the fact that we've taken out tail risk. I said before, that is how the stock market operates. Not every market operates like the equity market. Equity market treats less bad news as outright good news. But we all know that in real life, beyond the psychological animal, remember, it was John Maynard Keynes who invoked that term animal spirits. Nobody talks about animal spirits when it comes to commodities, when it comes to bonds, when it comes to gold. Animal spirits always pertains to the stock market because it's Gordon Gekko, it's greed, or it's fear, the two primal emotions. But there is a big dichotomy because gold is definitely telling you there's reason for concern from a stability standpoint, economic, fiscal, financial. The US dollar going down, that is, we may look back for all the people that are, and look, the retail buying of equities has been enormous in the past couple of months. It's not buying the dip anymore. It's like piling into strength. We have a tremendous momentum trade going on right now that people may regret when they look back and say, aha, you know what? The dollar market actually gave me the amber light to sell into the strength, rebalance my portfolio, reposition it for defensiveness. But no. But right now we're back chasing the herd. But hey, why not? There's no recession, right?
Dave, I have to say, this has been awesome having you back on. Before I let you go, any parting thoughts for the audience? Anything that you would like to leave them to think about or let them know where they can find your work? The floor is all yours.
Sure. I'll just finish off with this. Diversification never went out of style. It should not go out of style. And I would say to make sure that you're positioned defensively, and I'm not saying be 0% in equities. I actually wrote a report saying, boy, if there's one sector that you want to own that encompasses growth and defensiveness and yield, it's utilities. So I'm very bullish. I call it, because I'm bullish on bonds, and I call utilities bonds in drag. We wrote a whole report on it. But I would say to be mindful of the beta of your portfolio, the cyclicality, and to make sure that you're diversified, very focused on quality. That is very important. But most important of all, Julia, the one word that I want to leave you with and everybody else, liquidity. Whether you're a business person or an investor, right here, right now, make sure you have liquidity on hand for the next 12 months. You're going to wish that you had. And in terms of finding me, you can go Google Rosenberg Research, come on the website. You can go into information at rosenbergresearch.com, and it'll take you right into the website, and you could actually sign up for a free trial, a 2-week free trial for everybody that's on this call. You just sign up, get a promo code, and you can kick my tires, and you can see what I do on a daily and weekly basis. So that's an offer for everybody on the call. And I'm not going to give out my phone number because that's maybe a little too personal. But for people that want to reach me directly, you can do this. drosenberg at rosenbergresearch.com. Rosenberg at rosenbergresearch.com, all one word. And I'd be happy to converse with you.
That's awesome. Dave Rosenberg, founder and president of Rosenberg Research. Thank you so much for being so generous with all of your time, your knowledge, your wisdom, helping us all learn and get better and just understand these things. I really, really appreciate you. And I don't want it to be 8 months before we get you back on. So hopefully in the fall, you'll come back on, but really, really enjoyed this conversation. Thanks again, Dave.
I sure will. And thank you very much for inviting me back, Julia. It was a lot of fun.
Of course, it was a lot of fun. Thanks so much.